reason for this webinar broadly is to help clarify what choices that regulators have in markets where they are depending on third-party financial service providers to provide some sort of digital cash equivalent to the market that banks are not providing. That's a complex way of saying, an electronic money institution is not normally a bank. They're not normally a payment service provider, and they occupy this unique space between those two categories of payments and deposit taking. As a result, they often sit on large deposits of cash, which accrue relatively significant amounts of interest. So in this regard, regulators are often stuck and unsure of what to do with that interest. Does it belong to the customer, or is this, in a sense, a revenue stream for the provider of the e-money and the e-money issuer? So we will discuss what trends are emerging globally and what options that regulators have if they would like to encourage the paying of interest on e-money. That's the first half of this discussion, which sort of sets the tone for the second half, which is this broader issue of supervising e-money issuers and ensuring that regulators understand the powers and tools available to them in regards to supervising this institution that's not a bank, that's not a payment service provider, and not a traditionally supervised financial service entity. So I will leave that there. Ross, Luis, Anton, feel free to expand on that if needed as you dive into the two parts. And one last thing is, for your questions, do feel free to use the chat function in the web app, so we can take your questions as we go, and then we can open it up to address those questions directly after the presentation. So our friends from UNSW, feel free to take it from here.
Okay, thank you very much, Ahmed. I thought I'd just introduce our little project and then hand on to Louise. We've got a DFS, Digital Financial Services research team at UNSW. We've been doing this for nearly 5 years. We've been affiliated and very grateful to UNCDF for their support for that. It's over 4.5 years now, and Louise has been, I lead the project, and Louise has been with me basically right from the beginning. And the purpose of the project is to grapple with regulatory issues in this space of digital financial services provision in developing countries. And if you're interested in what we do, I'll just say it now so I don't forget at the end. All you have to do is Google UNSW, which is the name of the university these days. It was a long name historically, but it's UNSW DFS for Digital Financial Services. And if you Google that, you'll get all, more than 70 different outputs up on our website. One of the things that, as Ahmed put it very well, one of the things that has led to tonight is we've realised over the years that regulators in developing countries often have more policy options than they realise. And so that's the purpose of tonight, not to tell regulators what to do, but to show them that there are some more options than a lot of them think they have, and they might be useful for them to know about them. So on that note, I'll hand over to Louise to talk about paying interest.
Okay, thank you, Ross, and thank you, Ahmed, for organising this seminar this evening. And you've had the background from Ross on our research project, and so I wanted to reiterate there that we have the background of the legal expertise, but also for myself, I'm a regulator, former regulator, so I also share the conservative mindset. So we have that understanding of regulators, I hope, not too conservative, but I definitely get where the regulators are at a lot of the time. And we see the providers in the market as wanting some legal certainty on how to structure their business model. So when we looked at this issue of encouraging the payment of interest on e-money, we had it very clear in our mind that the providers are looking for legal and regulatory certainty in order to structure their business model in a way that's compliant. And so we want regulators to respond to that and make sure they're clear to providers. And we want to give regulators all the various options that we've come across in our research, and also not just come across, but just ideas that we've developed through our research on how regulators can structure their regulatory approach to address this issue. So the just defining a note on terminology for e-money, we're referring there to electronically stored value, which is sent and received using an electronic device, and that usually is a mobile phone. So we usually talk about mobile money. And the problem that we've often heard discussed in a number of markets is e-money account numbers might be high. There might be a very high success rate in registering users, but then after that initial success, the usage rates remain low. This is not the case in every market, but we do know we come across this usage rates being low. So how do we encourage the payment of interest on e-money? It's in a way that can benefit not just customers, but providers and agents as well. So the regulatory what we've picked up anecdotally is the regulators are conservative in this area. They are concerned that the payment of interest to e-money customers may mislead those customers into thinking those e-money accounts are bank accounts. And the problem for regulators there is that these e-money accounts are not subject to the same safeguards as bank deposits. There's typically no deposit insurance protection for these e-money accounts, and they're also not subject to prudential regulation. And nor would it be sensible to apply deposit insurance protection or the full suite of prudential regulation for these e-money accounts. But the regulator is then put in that situation of, well, what if the customers do think these are deposit accounts, and if there is a problem with the e-money provider's business, then what happens there to the e-money accounts, the stored value? However, we think these concerns are not valid, as we explain in our research paper and this webinar, and we think there is a lost opportunity occurring here. So what we'd like to emphasize is that the payment of interest is not necessarily a defining feature of a bank deposit. May not, it doesn't necessarily have to be the case because e-money having interest paid on it that the customer will automatically think it's a bank deposit. And it's even if that's just a perception, it's also a legal issue as well. So for example, in the UK, in the US, it's not a legal requirement to pay interest on a bank deposit, but this is not in every jurisdiction. So we know, for example, in Russia, there is a legal requirement to pay interest on a bank deposit. And also from your own experience as well, you'll know that some bank accounts are just operating as transaction accounts, like a checking account, and those bank accounts won't commonly attract interest. So we use that discussion to really emphasize that the payment of interest does not have to be a defining feature of a bank deposit, and therefore if e-money attracts interest, it does not necessarily become a bank deposit. But also another concern by the regulators is that they think maybe the payment of interest will mean there's an increased risk of the stored value, increased value at risk. And as we go through on this slide, there are a number of ways which are used to mitigate the risk. First of all, we note that the e-money providers are not intermediating the stored value like banks intermediate deposits. Depositors hand over their money to banks, usually with the full understanding that that money is then on lent. It's intermediated within the financial system. Whereas e-money, that is not on lent. It can be invested in very low risk assets, or it can also be held on trust with a regulated entity. So the amount on issue, the stored value, is ring fenced and kept safe. We can also use market conduct regulation to ensure there's adequate disclosure to customers, so customers are well aware of the risks of the e-money. And you can also reinforce that with financial literacy and just make sure customers are aware of their rights and responsibility. And we think regulators have a responsibility to look at these issues and address the concerns about e-money through those issues. So in our research paper, we have these 4 different options that are basically 4 different approaches that we've identified to deal with the interest payments. The proportional prudential regulation approach is what we term the approach used by Colombia, where essentially they do define e-money issuers as deposit takers, but they apply a light touch regulatory framework. And then we've termed what is happening in Tanzania as the permissive approach, where the issuers, the providers, are able to pay interest. They're permitted to pay interest to their customers, but how they do that is really left up to the providers. And that contrasts with Ghana. The mandated approach is what we've termed it, because in Ghana, as you may be aware, the Bank of Ghana was very specific in mandating how the interest would be paid to customers and how much would be paid and at what interest rate. And then the 4th option we explore in our paper is the trust protector approach, where the protector in a trust is given the responsibility for ensuring the interest payments reach the consumer, reach the end users. So there is 4 different approaches just to consider for regulators, and depending on your local context, one of those may be suitable. So for example, we use this slide to show there are a number of different approaches used in different countries, the way they'll treat interest. And we would note that this slide, the treatment is not necessarily mutually exclusive. So for example, in Ghana, the issuer, the interest must be paid to the customer, but at the same time, the issuer can keep some of the interest. And in contrast, in Namibia, the issuer can't share the interest with the customer, but they are allowed to keep it. And we've got these 2 case studies here, which show 2 contrasting approaches, which I've already mentioned in previous slides, but there are 2 very interesting cases in the very contrasting ways they've gone about determining how the interest should be shared. But there are also 2 economies which have had great success in their mobile money services. So in the last couple of years, the amount of transactions have grown exponentially in these countries, in Tanzania and Ghana, and the amount of profits or interest distributed back to customers has also been growing. And that slide there just gives you some references on the amount of money. It's not an insignificant amount of money returned to customers, and it gives you some very small sources there, but when you receive the slides, you'll be able to click on those sources to find out more information. And these, it just shows, these 2 countries took very different paths, and it's interesting for the country to decide which path it would take. It really depends on the local context. So in Ghana, there was a lot of discussion between the Bank of Ghana and the issuers, the e-money issuers and the banks as to how much interest would be paid, what was an appropriate amount of interest to be paid, and how would they arrive at that level of interest. Whereas in Tanzania, it was much more left up to the provider to decide how to pass on the benefit of the interest. So on that note, I'd like to move on and pass it back to my colleague Ross Buckley, and he'll explore some of the questions that may be coming up on the payment of interest on e-money. Thank you.
So we've suggested a couple of questions here. But you're very welcome to also ask your own questions, of course. But the questions we're sort of suggesting you might like to speak to from the audience are: do you think paying interest in your jurisdiction, in your country, would encourage uptake of digital financial products by customers? And for any regulators in the virtual room, is interest paid on e-money in your jurisdiction? And if not, is it because it's not explicitly allowed? Might it be useful for there to be an express guideline or something saying that it is legitimate for e-money providers to pay interest, or is it just not done as a sort of matter of custom? So over to members of the audience.
Any questions from attendees? Or a response to the questions that Ross just asked?
Hello, this is Charity from FSD Zambia. In my country, they do not pay interest on e-money on the wallets or as a savings. But I think if they paid interest, people would be attracted to go to the savings on e-money on the platform. So yes, as you explained, it would be better if there was some interest paid, then it would be more attractive.
Yes, look, thank you very much for that. I mean, that's very much our thinking, that what we're really trying to do with e-money is affect a cultural change. We're trying to encourage people to move away from cash into a digital environment, and interest would be some sort of incentive, wouldn't it, to do that? Are there other people representing other countries? Do you think it would be helpful in your country?
Maybe I can step in here and share some observations I've seen from various countries. I feel as if many regulators see e-money as a payment solution rather than a savings solution, right? And introducing interest and exactly the context that Charity highlighted, which is a valid one, attracting people towards e-money for the purpose of medium to long-term savings that would justify some sort of return, is actually and the antithesis of what policymakers originally issued the e-money license for, which is this intermediary function to facilitate digital payments. And so we're kind of shifting the purpose towards the potential. And so I think in terms of that frontline experience, it's really, I think some regulators could use support and understanding what that potential is, and then figuring out the sort of regulatory consequence of that, if that makes sense. And Till is here, he's got a question as well, or an observation.
Yeah, actually it's a bit of a three-part question, sorry for that. One is there something endemic about the nature of the trust type relationships of mobile money that limits the ability of the bank to use those deposits, which might in turn justify not paying interest? For example, are there restrictions in what they can actually invest in with those funds, which limits their ability to make money on them? The second question that I have is, you mentioned that there's a concern that they would then have to apply deposit insurance if they were paying interest. So I guess I would just put it back and say, would that be such a bad thing? We've traditionally thought that deposit insurance is linked to the size of a deposit, but when we clearly see that these are deposits but just held in aggregate, are we just suffering from a lack of imagination? And maybe we should reconsider the role of deposit insurance to apply to these types of accounts. Because I think that the trust in the system, in addition to the lack of paying interest, is one of the hurdles that customers face when determining whether or not to leave money on the system. And then I had a third one, but it's escaped me. So I'll come back with that one. Thanks.
Yeah, okay. Great. Thank you. Thank you, Till. Shall I jump in there?
If you wish,
yeah,
yes.
if you like, I can The first question, Till, you made was, yeah, that's a very good point about the return on the funds, and often that is a concern. You know, this is a high volume business, and it's not getting the high margins that we see with the banking deposits. However, I think in the case of Ghana in particular, when there was a lot of discussion in the country over what would be the interest rate payable to customers, they did actually go and ask, okay, to the banks, what interest rates do you pay on your overnight deposit, overnight accounts held with the central bank, for example, or what is the interest rate on your checking accounts, those transaction accounts, those ones that we typically associate with the very low interest. And they came back with quite a wide range between 1% and 7%. So from that, they were able to say, well, there are some banks paying interest out there on these transaction accounts, which are traditionally considered very low profitability accounts. And so from there, they actually mandated the interest rate payable. So I think there is the argument that, you know, we don't want to squeeze the banks and squeeze the providers, but I think there is money there that should be returned in some way for the benefit of the customers and benefit of the digital financial services ecosystem. And then on the deposit insurance question, I think that's a really good point as well. And I know there's been quite a bit of research internationally looking at how the deposit insurance frameworks could be applied to e-money. And as I understand it, is an issue of cost, and they're just working out how do we price this and make it still that you want mobile money to be a viable product and not weigh it down with increased costs in operating.
Yeah, thanks, Louise. And if I could have a go at both of them too, I think generally banks still can intermediate the monies they hold in trust accounts. So if they're still intermediating it, if they're still lending it out to somebody else, there's no reason they can't, pay interest on it. And that's what would normally happen in developed countries. I mean, the precise answer to the first part of your question might vary country by country. There might be some countries where that's not the case. But generally, in most countries that I'm aware of, banks do intermediate money they have in trust account, and therefore they can pay interest on it. The deposit insurance question, Louise is right, of course, there's been a lot of research on whether e-money should attract deposit insurance. But my personal view is deposit insurance has to be paid for. It has to be paid for by somebody. And it normally, with the typical trust arrangement, it wouldn't attach to that because there's usually a cap on the amount. So, deposit insurance extends to, customers' exposures in their account up to a certain amount. And in this case, it's just the mobile money provider who's putting the money on deposit with the commercial bank. So the amount's going to be very, very large, and deposit insurance isn't going to apply. We could make it apply, but then there would be an expense associated with doing so. And I'm not sure if the digital financial ecosystem should really carry that expense. And I'm not sure it's really necessary. If you've got the trust arrangement set up properly, it should be extremely safe anyway.
So thanks, Ross. And then just to follow up, I know that we're not talking about the security of e-money in this. You've done great work on that as well. But if you looked across the countries that you provided as examples, those that do pay interest, are there any restrictions on the use of the money that's in the trust, or is it used liberally by the banks to fund their assets? And I ask because it's directly linked to what they then could pay as far as interest.
Yeah, and there is, I think, quite often there are limitations. The bank is restricted to investing in, liquid government securities or, some other sorts of relatively low risk assets. So you're absolutely right. The minute you have rules like that, then you put a natural cap on how much money the money is earning, how much interest the money is earning. But I think the important point still comes back to the fact that even if we're paying relatively modest amounts of interest, we're doing two things. We're sort of encouraging the use of e-money, and we're encouraging savings, and we're starting to build financial literacy because we're providing inducements for people to, go about their behaviours differently than they have before.
Great, guys. I'm just looking at the time and realize that there's two other questions here in the chat, one from Carlos and the other from Cyprian. So can I suggest perhaps that Ross and Louise, you guys take a look at those and see if maybe we can answer those before moving on to the supervision section. I think Carlos's question is an interesting one in terms of the correlation between interest payment options and tax policy applied to e-money issuers. I guess this is part of a question of, are e-money transactions taxed? And by e-money, mobile money transactions, which is usually Tanzania, Uganda, Kenya, sort of that debate has been raging for a while on the taxation of mobile money. But you feel free to interpret this question as you will, and Carlos, feel free to step in if you need to clarify.
Louise, do you want to have a go?
Yeah, I think in terms of is e-money taxed? That's an interesting question as well, and I think the jurisdictions that are looking at taxing e-money are not necessarily the same ones that would be looking to pay interest on e-money. So in a way, it comes at the problem in this two different directions. So if you're going to tax the e-money, then the argument should be that the tax is then used towards developing and promoting digital financial ecosystems and promoting financial inclusion through that e-money tax. So in terms of country examples, I think that was part of the question as well. I'm sorry, I don't have those to hand, but yeah, because we're more focusing on coming at the angle of payment of interest. Does that answer the question? And did you want to add anything, Ross?
No, I think that's good.
Yeah, I mean, I think this is, we've kind of raised three different issues as it applies to e-money that we don't have the time to talk about here. One is this interest issue, but the other is the security of the funds where they're invested and the capacity to protect that, particularly in terms of subordinated debt. And then thirdly, this issue of taxation is revenue generation, period, for these very high volume payment services, effectively payment services. And those are obviously interrelated. You kind of can't separate them from each other, and yet they all require a dedicated look at themselves as well. So, Carlos, you put your finger on a delicate issue.
I want to.
So Cyprian's question, perhaps you guys take a stab at that, and then we can move on to the next section.
Yep. Louise again.
Yeah. Sorry, Ahmed, can you read out Sabrina's question?
Sure. It says, how does the uptake of mobile money compare between countries where interest is paid? That's basically the gist of the question.
Yeah.
Yes. Okay. No, that's a good question, and we were also looking for research on that as specifically as well. So I think it to take the easy answer, I could say it's early days. But I think, the specific research, we haven't found a specific study looking at the uptake of interest on this, success. So the uptake of e-money being driven by the success of this interest payment initiative.
Well, the reality is you can't split it out, can you?
No, because that's what I was going to say.
The uptake in Tanzania. Yeah, that's right. The uptake in Tanzania and Ghana is both very good, but we'd be fooling ourselves to say, well, most of that is about interest being paid. I doubt that. I think most of it is probably other factors, and there's a lot of different factors that make a digital financial ecosystem flourish or not. So, you really can't. This is just something I believe that supports the development of an ecosystem, but I think it's fooling ourselves to suggest we know precisely how much it contributes versus other factors.
Great. I think that's a great answer, and it does highlight that, I think our role is to help providers and regulators play with the different variables that impact uptake, right? And we talk about interest as a pure function of revenue, but it's also a function of building trust, right? And so that aspect of it means that there's a bigger question in terms of why the customer isn't using it and why cash is still king. And I think that's a great segue into the next section, which looks at this broader issue of what can regulators do in terms of supervising e-money and what are their respective sort of resolution powers given the quote unquote risk of e-money issuers.
Yes, and thank you, Ahmed. So I'll speak to this. So it's perfectly normal when, and I'm sure most of you know this, whether if you have a bank or a financial institution, it's perfectly normal for the regulator to have resolution powers. In other words, to be able to step in and take over if the institution's in trouble, operate the institution for the benefit of the depositors typically, and basically this is usually done by putting somebody in to take over the roles of the CEO and the CFO and whatever, and run the thing and conduct an orderly winding down of its activities if it's in a sort of terminal state. And normally these resolution powers do not extend to telcos, to telecommunications companies, and it's normally telecommunications companies that are issuing e-money. And the reason the resolution powers don't is that it's an institutional thing. The regulations will say that the central bank or whichever regulator it is has this authority over banks and financial institutions. So usually the powers are missing, but at least in some economies where e-money is becoming very well established, e-money operations are starting to become systemically significant. So it's not just a matter of protecting the customers and protecting the float, which most e-money arrangements do pretty well, I think, these days, but it's also about the economy-wide disruptions that could happen if what is becoming one of the most important payment systems in an economy suddenly stops functioning. So in this situation, it would be a really good thing for if this really critical payment system stops functioning, for a regulator to have the power to step in and take over and make sure it keeps working. So we've come up with 3 different ways a regulator can grab this power for itself. The first is to have it granted to it by regulation, so by guidelines or regulation, so some sort of legislative instrument, or the powers could be imposed as a condition of the license. So when the e-money provider comes and seeks a license to be able to issue e-money, one of the terms could be, well, if you get into trouble, these certain sorts of events happen, we can revoke your license, but we can also have these powers to come and run your business in the public interest. Or the third measure, as you'll see on the slide, is that the powers are granted to the protector under a trust deed. So when the e-money is put on trust and the trust deed which creates that trust usually should provide for a protector to enforce the rights of the customers, that protector could be given certain powers. As I'll show in the next slide, that's a bit more limited than the first 2 options. So the first one, using regulations to address the issue. There's one example here on the slide, Kenya. The other example is Mauritius. In both of those countries, the regulations expressly say that the regulator has the power to step in and resolve an e-money issuer that is in serious difficulties. So there's sort of 2 countries that have gone in that route with express regulation. That's, if you can get a regulation, that's the cleanest and best way to do it. The reason we looked at the others is that in some countries, passing a new regulation is not a simple thing, it's not a quick thing, maybe politics, difficult politics involved. So if that's the case, then you may well do something a bit less than a regulation. Whatever you do, if you're going to have resolution powers over a telco, probably the most important thing is an obligation that the e-money business be conducted in a separate wholly owned subsidiary within the telecommunications company, because the central bank or the regulator is not going to wanting to try and have to resolve a whole telecommunications company. That would be way outside its sphere of expertise. It's only going to want to be in charge of the e-money issuing part. So I think Kenya requires that it be operated in a separate business unit within the telco, but the Philippines, Ghana and Tanzania all require a separate legal entity, which would typically be 100% owned subsidiary. And that's definitely a better requirement, because if it's in a separate legal entity and it needs to be resolved, the edges of the entity are going to be very clear. It's going to be obvious where it starts and stops, what assets are in it, what assets are not in it. If it's a separate business unit, may be fuzzier. And in this sort of situation, you don't want fuzziness. The second option is if regulations are difficult to achieve, is to make it a condition of the license. That should certainly work. And it's a simpler thing because typically it's within the power of the central bank or the relevant regulator to issue a license, and therefore it should be within their power to put whatever conditions they want on the license. The third approach is to simply have the resolution powers as a term of the trust deed under which the money is held on trust in a commercial bank account. This is okay, but it's not as good because it doesn't give the regulator control over the whole business. It only gives the regulator control over the money that's on trust. And it's more useful in terms of perhaps keeping the payment system going. If it's systemically significant for the economy, the regulator may well want to keep the payment system going, try to find some other company to take it over, sell it to somebody else, do the sorts of things that are normally done in resolution situations. Having it in the trust deed won't achieve that because it only gives you power over the funds on deposit, not over the whole business. So it's the sort of second best option that you'd only do if you couldn't get one of the first two. And that slide is just making that point that the power is only over the float, not over the entire business. And ideally, you want it over the entire business. So again, questions, that's a quick run through, but questions for you, questions for the audience. There's a couple of countries where this has been done, Ghana and Mauritius. Resolution powers have been granted by guidelines. There's at least 3 countries where the requirement is at least there that the e-money business be operated in a separate subsidiary within the telecommunications company, obviously with an eye to making resolution much easier. What do people in the audience think in your countries? Would this be a good thing? Is it practical? Is it something you think it would? It probably isn't going to change confidence in the e-money ecosystem when problems don't arise, because customers probably don't think this far ahead. So, but it is important. It's going to be important, I think, if the whole system is teetering on the brink of falling over. But again, over to the audience. Questions, discussion.
Any questions or thoughts from the audience on this? Let me jump in here real quick. I think this one thing we're seeing as a trend is that many of these e-money type guidelines are actually bundled into a broader mobile money regulation, where they may, in many cases, go as far as defining e-money, but the resolution or the context of the regulation is broader than simply the idea of issuing electronic money. It's usually coupled with KYC requirements, certain AML rules, customer protection rules, agent guidelines, etc. And so one observation I would make is, I think for regulators, having such clarity on the resolution powers in terms of e-money is often clouded by this other context, other contexts of risk, whether it's AML or whether it's consumer protection or whatnot, that is bundled, quite literally, into the same entity. So from your perspective, do you think that's true? Maybe I'm just making this up. And if so, how could we help regulators sort of isolate those resolutions as they pertain to one category of risk?
Look, I think that probably is happening to an extent, but it's I think one of the reasons we sat down and wrote our paper was sort of precisely that reason, to stimulate regulators to think about these things more clearly, and I think to realise that they've got more options. You know, the fact that they've always had resolution powers over banks and financial institutions and never had them over the money issuing parts of telecommunications companies simply doesn't mean that they shouldn't have them over e-money issuers. You know, they probably should. It's a very sensible thing to have in your regulatory, armoury. But it's history sort of rules in a lot of these sorts of spaces, and people are just used to the way the system grew up. But in a number of countries, e-money is becoming the dominant payment system. And again, in developed countries, regulators spend. I know in Australia, the Reserve Bank spends a tremendous amount of effort on our payment system because they see it as the lifeblood of the economy. We've just got a new payments platform, I think last week, which gives you real-time retail payments. And that's been a huge effort to sort of get that up and running. But there's no doubt, no question in Australia of the importance of really robust, strong payments infrastructure. And e-money is providing that payments infrastructure in a lot of economies. So it's I think it's the responsibility of the regulators to make sure that the structure is really robust. The first time a payments infrastructure sort of collapses, it starts to regularly collapse, it's not going to be good for e-money operations in other countries.
Right. That's a fair point. And I think part of the question is what kind of e-money institution collapses? A subsidiary of a MNO, that collapse might give a very different regulatory response in terms of whether it's an independent third-party e-money issuer as well, in terms of expectations and scale of impact.
Yep, absolutely. And the other thing is that when something collapses is not the time to be working out whether you've got jurisdiction and what you're empowered to do. It's the way the world works. That's just not a good time to be asking these questions. It's far better if the questions were asked and answered, when in the calm light of day where there wasn't a problem.
Right. And I think that's really the intent of this webinar, frankly, is to help us in the field engage with regulators to help them ask those questions now before there's failure. Speaking of us in the field, are there any questions or comments from the attendees out there? Okay. You guys are abundantly clear, clearly.
Well, we must have left no doubt at all.
Yeah. I know you had a couple slides left. If you'd like to.
There's somebody typing a question, so maybe you can
No, I don't think so.
No, yeah, there is someone. Oh, someone was typing. Sorry. But I think it's an important point that Ross already made is that it's just because it hasn't been thought of applying resolution powers, it hasn't been thought of in great detail for e-money issuers, doesn't mean it can't be done. So there's a lot of work going on internationally to improve the resolution powers framework in a number of countries. So yeah, this is a good time for regulators to be thinking about e-money issuers. And to do it in a simple way, not a complex, overly complex regulatory way.
Now that's a very good point, Louise. The countries that have done it have done, Mauritius and what was the other one I said? Kenya, have done it very, very simply. Through
guidelines and
they have not done it the way we would try to do it in a sophisticated developed country. They've literally done it with a guideline that is only 2 or 3 sentences long, but that gets them there. That just gives the power to the central bank to basically do what it chooses what it deems necessary in running the business, revoke the license, take over the business. It doesn't have to be complicated. You can say it in 3 sentences.
Hello,
But it's
I'm sorry to hear Zambia. Can I add in something? So in Zambia, we had the e-money regulations revised late last year, and FSD was privileged to be part of that team. They did try to catch an audience from most operators and service providers dealing with mobile money. But I think the issue of whether people should gain interest on their savings didn't come out strong here. I think like Till might know that for the reason that saving on the wallet is not yet so popular in Zambia. So yes, I've picked something from your last discussions about the benefits, the trust that can be built in and everything. And I will try and share with the central bank that these are some of the highlights that are coming with building trust on the mobile money. And secondly, the issue of the trust funds, I've also learned something. Here, there's been a directive by the central bank to use the funds, the interest on the trust funds to go towards the common good of the end user in mobile money. But that has been or just a lip service for 3-4 years. They talk about it and they still aren't using it for awareness. You might know that awareness is some of the key issues that we're dealing with here. So sometimes the implementation of the good ideas can be quite difficult. I don't know how you would advise a way of communicating that these things are actually being discussed on the World Platform, and it would be good that they pay attention to them. What would be your advice?
Oh, I think you're better placed to know how to do that in Zambia than surely we are. That there must be a lot of local knowledge required to answer that question, I think. But I think you've highlighted an important thing though, that a number of countries have done that, have said that the interest needs to be used to promote financial inclusion, to build awareness among customers or whatever. The weakness of that as a regulatory approach is the fuzziness. And that you can get into arguments about whether it's being done, whether certain expenditure is actually in that category or whether it's expenditure that the mobile money provider would have made anyway as part of promoting their business. Whereas if you have a sort of a regulation that requires interest be paid, or at least facilitates it being paid and makes it very clear that the provider is entitled to pay it, and you've got any sort of competitive environment, which seems to be what's happened in Tanzania, there's a clarity to passing funds on to customers that doesn't exist with paying money to promote awareness or promote financial inclusion. It's reportable, it's clear, it's everybody knows how much has gone to customers, and that's a real benefit of that regulatory approach. I think the providers can't fudge it.
Yeah, and I think, Charity, you bring up a great point here, and one that's probably the most accessible to most of us in market in terms of sort of intermediary solution for regulators who want to do something in this regard. And I think regulators generally don't appreciate their role in communication and communicating to the industry and to customers what they can and can't do. And in this case, we talked about interest as an example of a way of driving trust as a proxy, right? And so I think part of the risk of passing on interest into sort of improving service as a broad category or customer benefit as a broad category is if the customer doesn't know that's happening, then it's not really driving trust in the system. Interest, as Ross said, is actually very clear. And yet at the moment, there's an ongoing conversation in Fiji, which Ross, you were just brought into recently, where actually the mechanics of passing on interest is very difficult for a provider. So irrespective of how easy it is to supervise and how unrisky it might still be very costly to do. And so using those funds to customer benefit it might be easier. And it's a question of supervision. How much are you paying out? How much are you gaining in interest, and how much does it cost to do X? So maybe one way to be more specific, to address the fuzziness, is to actually help the regulator think of categories of customer benefit, right? So how do you improve financial capability? How do you improve the quality of service distribution, say agent networks? How do you improve customer outreach? So for example, for all three of those, maybe putting some of those funds into a marketing campaign to improve literacy and capability, and then communicating to the public that that's what it's being used for, or using that to improve agent training, or extending what's a call center hours so they're more accessible to more people. Like those are very specific ways to address customer benefit. Now the challenge here is that regulators shouldn't be so specific as it mandates a business how to do its business, right? So ideally this would be sort of negotiated with the industry, and that's where the difficulty comes in. And I know we're talking about interest specifically, but it's this broad question of, despite a regulator having a lot of resolution powers in this context of risk, there's been very few examples of this being very risky. And the idea, the hypothesis is that we can drive usage, and great usage of digital payments and digital savings offsets the potential high risk because of the scale of use, right? And so, I think our role is to really engage in dialogue with regulators and hopefully send them copies of this webinar, to help them address that fuzziness.
Thank you. I like that. Thank you very much for the guide.
Great.
Any other questions, or will we wrap it up there?
I think we're good. We can definitely take any questions from any of the attendees after the fact. They can send it to the UNSW team directly or to us here at M4P, and the comms team will pass those on. I'd like to thank Ross and Luis and Anton for their work and their research and for the presentation today. And of course, thank all of you attending for your attention. And please do let us know if and how any of this has been helpful to you in your work in the field. Thank you very much.
And thank you, Ahmed, for making it happen.
Thanks.
Take care, everyone.
Bye-bye.